Okay, so, have you ever thought about what actually happens when you buy a stock? You just tap a button on your phone and boom, you own a tiny piece of Apple or Tesla or whatever. It feels so simple,
It
right?
really does. It's almost like magic. But as with most things in the world of finance, there's a lot more going on under the surface than meets the eye.
And that's what we're going to dig into today. We're going to take a deep dive into this book that really pulls back the curtain on how the stock market actually works in this crazy digital age, especially this thing called high-frequency trading. Ever heard of it?
Oh, yeah. High frequency trading, or HFT, has been making headlines for years. It's this super secretive world of algorithms and supercomputers where firms try to make money by exploiting tiny, like fractions of a second advantages in the market.
And to really wrap our heads around it, we need to start with a story. The story is Sergey Aleninkov, a programmer at, you guessed it, Goldman Sachs. Back in 2009, this guy was arrested for allegedly stealing source code when he left the company.
And this wasn't just any code. The prosecutors claimed that this code was so valuable, so powerful, that it could be used to, and I'm quoting here, manipulate markets unfairly.
Which is a pretty wild claim, right? I mean, this is Goldman Sachs. We're talking about a firm that was deeply involved in the whole financial meltdown of 2008. And yet, this code theft case was like the only major prosecution that came out of that whole mess.
It really makes you think, doesn't it? What was so special about this code? What could it do that was so potentially dangerous? And does this mean that the markets are being manipulated, maybe even right now as we speak?
Big questions, right? And those are exactly the questions we're going to explore today. We're going to try to demystify this world of high-frequency trading, understand how technology has transformed the stock market, and see if we can uncover any surprising or even disturbing truths along the way.
So buckle up, folks. We're going deep.
Okay, so let's start with something that seems pretty basic, speed. It turns out that in the world of trading, speed has always been a huge advantage. And we've got this story about a guy named Dan Spivey who really highlights this.
Spivey was trading something called futures contracts back in the day, basically agreements to buy or sell something at a set price in the future. And he noticed these really small price differences for the same contracts between Chicago and New York, like a tiny fraction of a cent difference.
Which doesn't sound like much, but when you're trading huge volumes, those tiny differences can add up to serious money. And Spivey was determined to figure out why those price discrepancies existed.
And what he discovered was that the information about those prices was literally traveling slower between Chicago and New York because of the way the fiber optic cables were laid out.
So instead of just accepting this, Spivey decided to do something pretty radical. He literally pulled out a map and started drawing his own straighter route for a new cable, one that would bypass all the twists and turns of the existing infrastructure.
And this meant going off the beaten path. We're talking about digging trenches through forests, running cables across bridges and private land, even convincing farmers to let him bury cable under their fields. And all of this to shave off like a few milliseconds of latency.
Milliseconds, that's a thousandth of a second. Most of us wouldn't even notice a delay that small. But for Spivey, and for the future of high-frequency trading, those milliseconds were worth a fortune.
He was obsessed with this idea of getting information just a tiny bit faster than everyone else. And it paid off. He ended up leasing out this new fiber optic cable for, get this, $300,000 per month.
Yeah, you heard that right, $300,000 per month. And Goldman Sachs was one of the first firms to sign up for this super fast connection.
It really shows how much value these firms were placing on speed, even back then. They understood that in the world of electronic trading, even a tiny speed advantage could mean the difference between making a fortune and losing your shirt.
And to maintain that advantage, secrecy was paramount. Spivey went to great lengths to keep the purpose of his new cable in the wraps. The construction crews laying the cable had no idea what it was actually for.
It was all very hush-hush, almost like a spy operation. And that level of secrecy really speaks volumes about the cutthroat nature of this industry.
Okay, now let's fast forward a bit and meet a guy named Brad Katsuyama. He was a trader at RBC, this big Canadian bank, and he had this anti-jerk rule where he wouldn't work with anyone he considered, well, a jerk.
Which is kind of refreshing, right? Especially on Wall Street, which isn't exactly known for its warm and fuzzy culture.
Yeah. But anyway, Brad eventually moved into the world of electronic trading. And at first he was super excited about it. He thought this new technology would make the market more efficient, more transparent, more fair.
That was the promise, right? Technology was supposed to level the playing field, make it easier for everyone to participate.
Exactly. But as Brad started actually trading in this new electronic environment, he began to notice some really weird stuff happening. Like, he'd see a quote for a stock, say, an offer to sell 10,000 shares of IBM at a certain price. But the instant he clicked the button to buy those shares, poof, the offer would vanish.
Like it was never even there.
Yeah. And this started happening all the time. It was like the market was playing tricks on him. He felt like he was going crazy.
And then there was this whole complicated system of exchange fees called maker-taker, which basically meant that you could get paid for placing orders in the market, or you could pay a fee to execute orders immediately. It was a really convoluted system that, honestly, even experienced traders struggled to understand.
Yeah, it was a mess. And Brad actually tried to game this system himself, thinking he could make some easy money. But it totally backfired. He ended up losing a bunch of money. And it really made him question what was actually going on in these markets.
It was a wake-up call, wasn't it? He started to realize that the technology that was supposed to make things fairer and more efficient was actually being used to create all sorts of new ways to exploit the system.
Exactly. And eventually the stress got to be too much, and Brad left Wall Street. But even as he was walking away, he couldn't shake this feeling that something was deeply wrong with the market, like it was rigged somehow.
And that's when he decided to try and get to the bottom of it. But the problem was, Brad wasn't a tech guy himself. He didn't have the skills to really understand how these electronic trading systems worked.
So he started putting together a team of people who did. Programmers, data analysts, telecom experts. He was basically assembling his own little squad of market detectives.
And one of the first things they did was to develop this program called Thor. And Thor was basically designed to allow them to see what was really happening in the market at a level of detail that no one had ever seen before.
Like, remember how we were talking about those milliseconds that Dan Spivey was obsessed with? Well, Thor could track market activity down to the microsecond. That's a millionth of a second.
And what they discovered was that the data the regulators were using to monitor the market, the data that everyone was relying on to understand what was going on, was incredibly out of date. It was like trying to understand modern warfare using carrier pigeons.
No kidding. And when Brad started sharing what he was finding with people, the reactions were pretty mixed. Some folks were genuinely terrified. They just couldn't believe how much they didn't understand about how the market worked. Others were, like, totally indifferent. They were making money, so why rock the boat, right?
Human nature, right. But a lot of people were just plain outraged. They felt like the market was fundamentally unfair, and they were absolutely right.
Now, one of the key guys on Brad's team was this former telecom expert named Ronan Ryan. And Ronan had this really interesting perspective. He'd spent years working with the physical infrastructure, the internet, the cables, the servers, all that stuff.
And when he started looking at the world of high-frequency trading, he was just blown away by the lengths these firms were going to gain even the tiniest speed advantage.
Like, they were spending millions of dollars to co-locate their servers right next to the exchanges, basically moving in next door to the stock market. And they were obsessed with shaving off nanoseconds of latency, which is a billionth of a second.
To put that in perspective, the blink of an eye takes about 300,000 nanoseconds. So we're talking about speeds that are just incomprehensible to the human mind.
Yeah, it's crazy. And Ronan also realized that most of the traders, the people actually placing the bets in the market, didn't really understand the technology they were relying on. They just knew that speed was important, but they didn't get the specifics.
It's like they were driving a Formula One race car without knowing how to change the tires or check the oil.
Exactly. And that disconnect between the traders and the technology really created this whole environment where things could easily go wrong.
Or be exploited.
Right. So as Brad and Ronan dug deeper, they started to see all sorts of predatory trading practices going on. Like, they found this small exchange called CBSX that had basically reversed its fee structure. Instead of charging firms to trade, they were actually paying them.
Which doesn't make any sense, right? Why would an exchange pay people to trade on it?
Well, it turns out that CBSX had just connected to this super fast fiber optic cable built by a company called Spread Networks. And by paying firms to trade, they were essentially attracting these high-frequency traders who could exploit that faster connection to get a sneak peek at what was happening in other markets.
It was like they were looking through a tiny crack in the wall, getting a glimpse of the future, and then using that information to place their bets before anyone else could react.
Now, another fascinating character in this story is John Schwal. He was a product manager at Bank of America, and he was known for being kind of clueless sometimes. Like, he once accidentally sent out a company-wide email with this embarrassing subject line, something about wings over Wall Street.
Yeah, not exactly the image you want to project when you're a high-powered banker, right?
But when Schwal got a look at what Brad and his team were uncovering with Thor, it was like a switch flipped in his brain. He went from being this kind of goofy, harmless guy to this, like, obsessed crusader determined to expose the truth about what was happening in the market.
He spent countless hours researching old Wall Street scandals, trying to connect the dots, trying to figure out who the real players were in this high-frequency trading game. He even used LinkedIn to create this, like, FBI-style organizational chart of one of the biggest dark pools, this one run by Credit Suisse.
And what he found was pretty damning. It was clear that these dark pools, which were supposed to be these safe spaces for big institutions to trade anonymously, were actually being used by high-frequency traders to front-run orders and basically pick off unsuspecting investors.
It was legalized theft, really, and it was happening on a massive scale.
So Brad and his team had this incredible tool, Thor, that could see all this illegal activity happening right in front of their eyes. But the question was, what could they actually do about it?
They knew they couldn't just go to the regulators because the regulators are already so far behind the curve, they were still using data from the Stone Age.
And they couldn't just go public with their findings because the banks they worked for were deeply intertwined with these high-frequency trading firms. They were all making money off this rigged system.
It was a classic catch-22 situation. They knew the truth, but they couldn't speak it without putting their careers and maybe even their lives at risk.
So they started thinking about building their own exchange, an exchange that was specifically designed to prevent this kind of predatory trading from happening.
And this was a pretty radical idea, right? I mean, the established exchanges, the NYSE, the NASDAQ, they were these giant, powerful institutions. It was almost unthinkable to challenge them.
But Brad and his team were determined to try. They believed that if they could build a better mousetrap, a market that was truly fair and transparent, then investors would flock to it.
And they were right. But it wasn't easy. They faced a lot of resistance, especially from the big banks who were benefiting from the status quo.
Goldman Sachs in particular was very hesitant to send any orders to this new exchange, which they called IEX. They claimed they had concerns about their own systems, but really they were just trying to protect their own interests.
But then something really interesting happened. One of Brad's team members, a guy named Josh, created these incredibly detailed visualizations of the trading data on IEX. And these visualizations clearly showed how the big banks were handling investor orders, and it wasn't pretty.
It was like they were caught red-handed manipulating the market for their own gain, and when investors saw this evidence, they were furious.
And that's when the tide started to turn. The big banks realized that they couldn't ignore IEX anymore. They had to start routing orders to it or risk losing their clients.
And then, on December 19, 2013, something truly remarkable happened. Goldman Sachs, the firm that had been so resistant to IEX, suddenly started sending a flood of orders to the new exchange.
It was a game changer. It was like the biggest, most powerful bank on Wall Street was finally admitting that the market was broken and that IEX was the solution.
And all of this brings us back to Sergei Alennikoff, the programmer who was arrested for stealing code from Goldman Sachs.
The irony is that the code he allegedly stole was likely designed to give Goldman an advantage in the very system that they eventually helped to dismantle.
It's almost Shakespearean, isn't it? The villain ultimately contributing to his own downfall.
Life is full of surprises, right? And this story really shows how even the most powerful institutions can be brought down by a combination of technological innovation, public pressure, and a few brave individuals who are willing to stand up for what's right.
So there you have it, the incredible and often unbelievable story of how high-frequency trading transformed the stock market and how a small band of rebels fought back to create a fairer system.
And for you, the listener, it's a reminder that even in a world dominated by algorithms and computers, human ingenuity and a commitment to fairness can still prevail.
Now here's a thought to ponder. If a few lines of code could potentially destabilize the entire financial system, what other vulnerabilities might be lurking out there in the digital shadows?
And as technology continues to evolve at an ever-increasing pace, what new challenges will we face in our quest for a truly fair and equitable market?
Big questions, and ones that we'll continue to explore in future deep dives.
Thanks for listening.
See you next time.